name's Wendy Jensen, and I live in Minneapolis right now. I went to Middlebury College for my undergraduate degree, and I'm working for a brokerage firm in Minneapolis area.
Okay, so in terms of the schedule, on Monday, assignment 3 to do, and then on Thursday, it's the last lecture. It's real fast. Assignment 4 is due. Okay, so as I said, assignment 4 is a good assignment in that it's kind of like forcing you to do a review, and in that class also the second half will do last year's final exam. So probably, my guess is you probably won't have time to look at that exam, given that you're doing assignment form, whatever other work you got to do in that last week, and also the stick with the finance exam always last in the exam schedule, thinking that it's the easiest one to grade, I guess. I understand. But at least you have some time to study for it. I guess that's positive. Any questions? Okay, there's a handout at the back that will start probably after the first half hour. Quantitative performance evaluation. Yeah, you can close out and turn in whenever you want. If you turn in today, that's fine. A number of people closed out their positions already.
Oh, mine.
It's fine.
It's totally fine.
I'm going to get it on an airplane.
Okay, well let's continue with asset pricing and risk management. So this is the equation that we looked at last time, and it's a regression equation where you take the return on stock I minus the risk-free rate, which is like we're doing monthly returns. This is a monthly return on, let's say, IBM, minus the 30-day Treasury bill rate, not annualized, just the monthly rate. And then regress on the market return, which might be the S&P 500 return, minus the Treasury bill rate. We get a beta out of that, and we get an alpha. There's also a residual, which has got an average value of 0 by construction in regression. So what we ended up last time is saying is that we could decompose the variance, or the volatility, of, let's say, IBM's return into 2 components. One component had to do with how IBM moves with the market. So as the market goes up and down, it's going to move IBM up and down. Another part has to do with what is specific or idiosyncratic to IBM. Okay. And that's the epsilon part. Those 2 things together are going to generate the volatility of IBM. So in a way, what we've done is just kind of like arbitrarily, well, it's not totally arbitrary, but what we've done is we've split up the volatility into 2 pieces. One piece that's kind of due to this common movement in the market, and the other piece which is due to things that are going on within the firm. And the sort of argument that we use is that the things that are going on within the firm, you should be able to get rid of in a diversified portfolio. So what I said last time was that there might be really good news from one firm that causes the epsilon to be positive, but bad news from another firm which causes it to be negative. And in a large portfolio, given that the epsilons overall have a 0 average, they're going to wash out. So sort of diversification benefit basically gets rid of this part, the epsilon part, or close to it. And what we're left is with the beta part. And what this leads to is the following intuition, that you're not rewarded for the volatility of the stock. So the risk of the stock is not the volatility. Because only part of that volatility is going to be rewarded. Okay, because we assume, okay, and I think that this is a reasonable assumption. There's a lot of assumptions in finance that are not reasonable. But this is a reasonable assumption, that people hold diversified portfolios. It might be at this point in time that your portfolio is not diversified. Okay? But you're not kind of the marginal investor in the market yet. So most people that have got sizable equity or asset portfolio are diversified into a number of stocks, a number of sectors, a number of different assets. Those are the people that kind of determine what happens in the market, determine what the reward is. Those are the people that are moving the price up and down. Those people have diversified portfolios. So the idea here is that only part of the volatility is rewarded. So you're going to find situations where you've got a very volatile stock with a very low expected rate of return. And that can happen. And that can happen if that stock has very low correlation or negative correlation with other things. Okay, when my research looks at emerging markets, brand new markets, of just unbelievable volatility compared to, let's say, the U.S. So U.S. standard deviation on an annual basis is 15%. And it's not unusual for some of these markets to have a standard deviation of 50 or above. So it's way higher standard deviation. But it turns out a lot of these markets have very low correlations or negative correlations. Brazil has a negative correlation with the U.S. India has a negative correlation with the U.S. Because of those correlations, it kind of like swamps the fact that they're really volatile. That you get this weird situation where you can put a stock into your portfolio that has 4 times as much volatility as the average stock in your portfolio. And it decreases the volatility of your portfolio. Okay, so that's something that is hard for a lot of people to understand. So let's just run that again. You've got the portfolio, the average volatility in your portfolio is 15%, the individual stocks. And the overall portfolio, let's say, is also 15%, which is going to be a very special situation. Okay? And then all of a sudden you add something with 50 standard deviation. It's way above the average. And then when you do that, your overall portfolio drops from 15 to 14. It's just happening because of the covariance. Remember, volatility of the portfolio is the weighted sum of, where the weights are squared, of variances, but also there's covariances coming in, or correlation. So correlation is very important. And in a way, the beta is kind of linked to the correlation. The definition of the beta is the covariance between I and the benchmark, M, divided by the variance of M. The correlation of I and the benchmark is just the covariance between I and M divided by the standard deviation of M multiplied by the standard deviation of I. So correlation and beta are very much related. 2 of the 3 terms are the same. Okay, so a negative beta implies negative correlation. So if you've got a stock with a negative beta, the expected return on that stock is going to be high or low. It can be low. It actually could be, well, it actually will be lower than the Treasury bill return.
But doesn't that depend on how the market's doing? But if the market's doing really badly, if it's negatively correlated, then wouldn't it be doing better?
Yes. But what I'm talking about is expected return.
Okay. So what you're saying is in a perfect world, the market's doing fine. You're talking about expected return.
It's true I'm making some assumptions like a perfect world. That's true.
Well, not perfect world, but I'm just saying hypothetically.
If you're sitting right now,
Okay.
what do you expect to get? Right now. What's your expectation? What's your best expectation? And it's the case that it could be that you accept an equity investment that's got a rate of return less than the treasury. And again, that, if you're just thinking of volatility as risk, that doesn't make any sense. Like, you look at two assets, a treasury bill and a stock. One's got, huge volatility. Why would you accept the lower expected return? You should be able to answer that question now. The reason is the correlation. This negative beta stock is a very special stock. It's got negative correlation. That's unusual. That's valuable. It reduces the risk of my portfolio. So I might be willing to take a very low expected return on that security. Is this doing a service for me? There's another question.
It was just, the benchmark again is just an S&P 500.
The benchmark is supposed to be a broad market portfolio. The S&P 500 is only a portfolio of 500 stocks. There's other portfolios like a evaluated portfolio of NYSE, Amex, and NASDAQ stocks that are available, or the Russell, 3000 is a larger portfolio. Those are all equity portfolios. Technically, we want all assets in this portfolio. It turns out that the correlation of the S&P 500 and these larger portfolios is, 95 or above %. We just need and maybe more importantly, the S&P 500 is kind of an agreed upon benchmark. What's key here is to measure your risk with respect to a benchmark that people kind of agree on. So often when you look at a beta, and I think on assignment 4 it directs you to like value line or something like that, which is in the library, and it records a beta for a security. That's almost always measured against the S&P 500. In the international asset pricing course that I do, the beta is always measured against the world market portfolio, where the U.S. has only got 40% of the world. Okay? So that's basically what's going on. This alpha thing is, for investment is a desirable property to have a positive alpha, because that means you did better than what was expected given the risk. Okay. This is just a graph, sometimes called the characteristic line, and all it is a scatter plot, which didn't turn out too well. A scatter plot of the realized excess returns on asset I on the y-axis, up here, and the realized excess returns on the market down here. So each point is like a month of data where, maybe a 20% return versus a 10% on the market. Up here is maybe a 30% return versus 30% on the market. So just a scatter graph. And all I did is put a regression line through that. And notice this is excess return. So excess means in excess of a treasury bill return. And it turns out the slope is the beta. Slope of that line equals the beta, and the intercept of that line is just the alpha. So it's just a graphical way to present that. That regression is sometimes called a market model regression. That's, you see it referred to as such. That's what people call it. I also report some betas of IBM that I estimated through June, I guess. And so it's just the sample period based on monthly data, an alpha, a t-statistic for the alpha, the beta, a t-statistic for the beta, and the R squared. Okay. And over here various periods. IBM's beta is fairly constant, though it does change. So the highest beta has been 56 to 65, and the beta actually increases in the most recent period. As IBM becomes more risky, I guess. And I also did it, I did an overall period, 10-year periods, and 5-year periods. The alpha, notice the alpha in all of these 5-year periods is not significantly different from 0. The t-statistic you need here is 2 to make it significant. Notice that if you estimate in the overall period, 26 to 95, that the t-statistic is significant. But you have to be real careful because this is just probably a trick of having, 800 observations rather than 60 observations. So I don't know if you learned this in your statistics course, but sometimes you can be tricked by, you have just a huge amount of data, things just appear significant almost always. And perhaps it isn't that meaningful to look at the relation between IBM and the market over such a long period of time, when the odds are that IBM is a much different type of firm today than it was like even 15 years ago, and especially 50 years ago. So what we do actually also in the second year International Asset Pricing course is that we explicitly introduce a way to let the beta change through time. We call that dynamic risk function. So the beta would be changing through time. So that's just an example of IBM. The next thing we need to know is how to calculate the portfolio beta. So I've got a number of stocks in my portfolio. What is the beta of my portfolio? Well, there's 2 ways to do that. The first way is calculate the portfolio returns historically and do the same sort of regression. Take the excess returns on the portfolio, regress on the intercept and the excess returns on the market. I get a beta and I get an intercept. So there's another way to do it, and that is to notice that the beta of the portfolio can be broken up. This is just the definition of the beta of the portfolio. And I can write the return of the portfolio is the weighted sum of the returns on the individual assets. And it turns out that I can bring those weights outside the covariance. And I get this new formula, which just says the beta of the portfolio is just the weighted sum of the betas of the individual assets. So this formula looks very much like the expected return on the portfolio. Remember, the expected return on the portfolio is just the weighted sum of the expected returns on the individual assets. Well, you just have another column with the betas. And the beta of the portfolio is just the weighted sum of the betas of the individual assets. Now this is, you might say, well, why not just run the regression? Well, it might be that you're just setting up your portfolio today. Right? And you want to ask the question, well, what's the beta of this portfolio going to be? Now, when I set it up in Excel, I guess I can figure out what the expected return is and the volatility, but what's my beta? Well, if I know the betas of the individual securities, then it's just a one-liner. I got the weights. Multiply the weights times the betas and sum. So this is a method to show us what the beta of the portfolio is. This is especially important because sometimes you're told that the beta of the portfolio should be close to 1, which means kind of like average risk. So the benchmark is the S&P. What is the beta of the S&P? 1, exactly 1. The covariance of the S&P with itself divided by the variance of the S&P is just the variance of the S&P divided by the variance of the S&P, which is 1. So if we're told to have a beta close to 1, then when we're actually going and solving for our weights, we could actually see what the beta of the portfolio is. We want to avoid a portfolio that's got a beta of 2. Now let me say something else about the beta that sometimes people get confused by. I think I said this last time, but I'm going to say it again. If you've got a beta of 2, the other way to interpret that in terms of the regression is that if the market excess return is 10%, the predicted excess return, given that 10% excess return in the market, the predicted excess return for this stock is 20%. Now, the key word there is predicted. What actually happens could be different. So really what the beta tells us is the prediction. So what could actually happen, if the market goes up by 10, your security might go up by, with a beta of 2, might go up by 25. Then the next realization of an up 10 in the market, your security might go up by 15. And the next time it might go up by 20. So on average, the 25, the 15, and the 20 indicate a 20% move up in the security or a 10% move up in the market. So another way to say it is that if the beta is 2, if the market excess return is 10%, then on average I would expect a 20% excess return on the security. So some people, as I say, get confused a bit of 2, said, well, why didn't the stock move up by 20% when the market went up by 10? Now, a lot of this has to do with also the R squared of the regression. If the R squared is like 99% and the market goes up by 10%, what do you expect to happen to the stock? It's going to go real close to 20. So maybe 19.9, 20.5. So the higher the R squared, the tighter this relationship between what actually happens in the market, what actually happens to the security. And you can see with the IBM regression that the R squared was fairly high. 43%, 52, 47, 48. Yes?
When you're figuring out the weight for the individual stock within the portfolio, do you want to look at just the number of shares, or do you want to look at the value of the stock in terms of, you know, like the number of shares times the price?
The weight is defined as the amount of money that you got in the security divided by the total amount of money that you have. So the amount of money is defined as the number of shares times the price of the share. So it's always the product of those two. That's the important thing. Yes?
When we're talking about return on the stock, does that include dividends or is that just
Absolutely.
Okay.
That's part of the return. So often return is broken into 2 components. The dividend return and the capital gain return. So sometimes that's separated out in the data. So if you search through DataStream, which is the library, you can get those 2 different pieces of the return. But always we consider both, put them together. Just like when we considered a bond return, we want to look at the coupon plus whatever happens to the bond price. Same thing. So the lingo in industry is we want to look at the total return. Total being the sum of the 2 components. And whatever else. Like there might be something extra that's given out, a special dividend, some warrants might be issued for, you know, for free. If they're worth something, that's got to go into the return also. Okay, so that's the formula for the portfolio. Here's some industry betas. So these are portfolios of individual securities, industry portfolios. And it's kind of interesting, I think. Notice that the highest beta industry is air transport. I don't know if you would have guessed that. I think I would have guessed that. Mainly because I've looked at this before. But if you think of the intuition behind this, the beta also has to do with kind of so-called cyclicality. The market kind of moves up and down into the business cycle. And people are referred to a cyclical stock. They're not talking about a stock that's moving deterministically with some sine or cosine wave. That's not what they're talking about. They're talking about how the stock moves with the business cycle or moves with the market. So air transport is a very, very cyclical stock, or portfolio stocks. And the reason is that when a recession comes along, they lose both the business travel and the tourist travel. So it's really bad news for air transport. Plus, they're really levered with a lot of debt. That makes things worse also. So the beta is very high. Now you think of some other industries like liquor, for example. It's not as cyclical, and maybe there's some intuition behind that. That in recession, maybe you drink more. So, and I think these are actually historical betas. I forget how they're estimated over. I pulled them out of some book. Notice tobacco is also low, and I guess the same sort of intuition that you're smoking more at bad times. But I actually think that this tobacco beta is probably a little low for me. Beta reflects risk, right? And I think the tobacco stocks are riskier than the market. Okay, so be careful here. These betas are estimated on historical data, right? And what you really care about is the future. Right? So don't be afraid to look at the historical regression, and it comes up with some data. And don't be afraid to say, well, I'm going to use my judgment. I really think that this is too low. That's very important. You have to know when to ignore the statistics. Yes?
Aren't the betas also influenced because none of these companies like tobacco are just in tobacco anymore? I mean, they're into food products and drinks and all sorts of other stuff.
Yeah,
so it's not just tobacco. You look at Philip Morris.
Right. So, and suppose that the tobacco beta, like for Philip Morris, the tobacco part of the firm had a beta of like 1.5, and the food part had a beta of 0.5. And there's exactly equal investment in both parts. What's the beta going to be? 1. So it works within a firm also. You can look at the individual components, right? And just take the weighted average to get the firm beta. So it works quite easily within a firm like that. And that turns out to be more and more important today in terms of calculating what the beta is of the individual business units within a corporation. And let me tell you why. Traditionally, the way the beta is used is to get some sort of target rate of return that investors expect. That target rate falls right out of the capital asset pricing model. You've got a beta of 1, and people expect the market to be 13% and risk-free to be 7. You can actually work out what the expected rate of return on this security is with a beta of 1. And what is it?
6.
That's the expected excess rate of return. The expected rate of return is 13. So it's used in the following respect. Okay, well, our expected rate of return is 13, so we're going to go through the firm and say that that's kind of the hurdle that we're looking for, and anybody who delivers more than 13 is really adding value to the firm, and you're going to get a bonus as a respect, as you exceed 13. Okay, so everybody see how that worked? We've got a beta for the firm that delivers some sort of target rate of return that investors expect. you exceed the target as a manager, you get rewarded. Simple. And if you don't exceed it, then there can be a penalty. So what's the problem with that methodology? Yes?
It's an expected rate of return, so it's just ridiculous if you don't, it's an expected rate of return. That's what
Okay, so let's fix it by having like a 3-year moving average of performance. So you could take a hit in 1 year, and that's okay. That helps?
that
Makes
makes
it
more
more-
sense.
Okay. So to make it a longer term compensation, I think would that would help your concern, which is a very valid concern. There's something even more fundamentally wrong with this approach. Yeah.
Some units within a firm are gonna have totally different betas.
Uh-huh.
And are a lot more risky than, like, the company I worked for, it was a commercial bank, they had a lot of different products, which some were very risky and some were,
Exactly. So that's exactly the problem. So, with the tobacco example, part of the business has got a beta of 1.5. Another part of the business got a beta of 0.5. So the expected return, or the target levels of return, are much different amongst the business segments. So when you're designing kind of like compensation scheme, or you're designing your budget, or whatever, the budget target should be directed towards the risk of the unit. And so this is an approach that is kind of obvious from just doing this lecture, but it's made a lot of people very rich in consulting. And the term is called EVA. I don't know if you've heard of that. You will hear about it in corporate finance. It's called like economic value added, EVA. And there's a number of firms that go around consulting. And basically what they do is they tell the firm, well, you've got to look at the risk of each business unit and assess what the expected rate of return is on each business unit. And then set your compensation based upon that, rather than some overall target. And as I say, it's obvious that you should do that, but a number of firms don't. Over the summer, I did some executive education where they brought in, some of the very top firms in the U.S. And it was just remarkable. We just go through the shareholder statement. And the CEO would be saying things like, we're looking for each division to deliver 15% return. Okay. And that could be very problematic, because there could be a division that should deliver 20. And if they deliver 16, they're getting rewarded. And there could be another division that, given its risk, need only deliver 10 or 11. And if they're delivering 14 or 13, then money's being taken away from them, they're not being compensated. So to have just one number, or reflecting compensation within the firm, only makes sense if the firm is in just one product line, or one line of business. As soon as you have different lines of business, then you've got to look, and this sort of beta analysis will help us do that. But more will be said about that in the corporate finance course. So always assess. Okay, now let me also give you another warning. When people look at a project to evaluate a project, like a new acquisition or building a new plant, to get expected cash flows, and then we need to do something with those cash flows, bring them to present value. So what is the rate, the interest rate that you use to do that, is no longer the risk-free, because these are risky cash flows. Okay, in all our previous examples, we knew what the cash flows were going to be, 10, 20, 30, 40, 50, exactly. Now they're risky. So we need some sort of discount rate that reflects the risk. So what's the discount rate or the expected rate of return? Falls right out of this. Okay, this is the limit. You tell me what the beta is of the cash flows. And that can be fairly routinely determined, even if they're just projected cash flows. You know that they're in a particular industry, and the industry is the steel industry, and it's got a beta of 1.02. You can calculate what the expected rate of return is. And we can use that as a discount rate. Yes?
Does that assume entire equity capital?
Yeah, and we'll adjust for that later, another lecture. Okay. So the question has to do with the discount rate could be affected by the amount of debt and equity that the firm's got. That's definitely true. But generally, I'm just trying to give you some preview of the intuition, is that we're going to discount our cash flows using a rate that reflects the risk of the cash flows. And this model delivers such a method to do that. And again, there could be a problem. That the firm, let's say, has got our example of the Philip Morris with a beta of 1, expected rate of return from the capital asset pricing model of 13. Should it be evaluating the projects in the food industry at 13%? Should it be using a 13% discount rate to bring those cash flows to the present value? If it does that, will it tend to reject projects or accept projects? Yeah. So you're going to be rejecting positive net present value projects if you use the overall firm's cost of capital or expected rate of return in this example for the food. And what about on the other side, on tobacco? Will you be tending to reject or accept projects in tobacco? So if you use the overall firm's beta to do the discounting or the net present value calculation, then you could be accepting projects you should have rejected and rejecting projects you should have accepted. Always use, and it's very important, always use a rate of return that reflects the risk of the cash flows that you're trying to evaluate. It's, I can say it about 10 times, but it's just remarkable that, large firms, really large firms, routinely make this mistake. It's one of the main things that I see that people are doing incorrectly in terms of project evaluation. There are a couple of questions. Yes?
Could I simply use half of the risk, like the 13% you give for the 0.5 beta, like 6.5 as the interest rate for the food industry, as an example?
So you're saying that the beta is 0.5. This is an exam question. Okay? The beta is 0.5. And therefore, so I tell you, with beta of 1, the expected rate of return is 13.
6.5 for the beta size. Right.
That's a true false why question. Everybody understand the question? So this is exactly an exam question. Expected rate of return on the stock with a beta of 1 is 13. Expected rate of return on the stock with a beta of 0.5 is 6.5%. True, false, why? No points for Steve or anything. Yes?
Well, it's going to be the expected excess return over the first period.
Absolutely. So you work it out. The beta of 0.5 multiplied by the expected excess return on the market is, well, we said 13 and 7. Right, so the excess return was 6%. So that's 0.5 times, let's actually just write it down. So 0.13 equals 0.07 times 1 times 0.13 minus 0.07. That's the beta of 1, right? That's a plus. And then the beta of 0.5 is 0.07 plus 0.5 of rating 2L today. that equals 0.5 times 6, that equals, is that correct? So remember, the capital asset pricing model gives us a relation between excess returns on the stock and excess returns on the market. Another version of that question is, which is very similar. If the beta doubles, the expected return on the stock also doubles. True, false, why? And we just provided a counter example to it, where the beta can double from 0.5 to 1. The expected rate of return goes from 0.1 to 0.13. Another version of that question is, if the beta of the stock doubles, the expected excess return of the stock doubles. True, false, why? It's true. Yes?
0.07 is the risk-free.
Yeah. And, you know, sometimes to solve these things, you just do a simple example. It doesn't matter what I use here for the numbers. You're going to get a proof by counter example. Well, there is one situation. Okay, there is one situation where the true, false, why goes your way. What's that situation? Yeah, don't make that assumption. It's trivial, right? Last time it was 0 was 1931. Okay, so there's always a way out, but let's not pursue that particular route. Okay, well, let's continue with this, and the next thing is the security market line. And all this is a graph of the expected return against the beta. So just think of a scatter graph of expected returns versus the beta. And it turns out that if we do expected returns, then everything should line up along this line. And this is just, it's called the security market line, but really all it is the fitted values from the capital asset pricing model. Fitted values, what's expected. So if you've got a beta of 0, then you expect the risk-free return. If you've got a beta of 1, you expect the market benchmark return. So this just represents the fitted values, and notice that it's a positive slope, which is what we want. So we want a situation, well, we want in the sense that this model makes sense. We want a situation where higher beta means higher expected return. And we can also write this in terms of expected excess return. And now it's the intercept here is 0. And at a beta of 1, the expected excess return is just RM minus RF. So just shifted it down by subtracting the risk-free rate. So that's a graph of expected return versus beta. So it's a scatter graph. Yes?
You mentioned earlier you didn't want to have a portfolio beta of 2.
Well, you might not want.
Okay, I thought you were stating it in absolute terms.
Oh, no,
Okay.
absolutely not. If I expect the market to go up, what sort of beta do I want in my portfolio?
Size you can get.
Yeah. If I expect the market to go down, what sort of beta do I want?
Negative.
Lower or negative. It might not be possible to get negative. You want to search for the stocks that have negative betas in a very small set. And actually, in that set, you might not even want to invest in any of them. It might be negative by fluke. Right? It could be negative because the market's going up and they're just diving. So the best you can do is kind of a low beta. And that's called market timing. So market timing is where you kind of shift your portfolio mix. When you think the market's going up, the high beta stocks, and then when you think the market's going to go down or soft, the lower beta stocks.
And that's when it's short. That's when it's short. Right?
Yeah. What is the beta of a short position? Yeah, negative. So if you can do that, then you're really timing, right? So then you can really shift it to negative. So you don't, in a way, you don't need to find those negative beta stocks. Then you can always put a short on. Possibility. or just sell the shares. Okay. What about tests of the capital asset pricing model? Well, they're, I think, fairly simple. The model, we could run this regression. The model says that the alpha should be 0, at least on average. So this is the capital asset pricing model, so we could, in a way, just test whether the alpha is 0. And people actually did tests like this. They created portfolios of stocks. Okay, rather than individual securities, ran regressions, and tested whether the intercept was 0. There's actually 2 dissertations out of Chicago in 1982 that basically all they did, like run 10 regressions and test whether the alpha equaled 0. They had to do it in a smart way. They had to do it in a way where you tested 10 alphas at the same time, rather than individually. But nevertheless, basically the same thing. It's just running 10 regressions. So they check to see, basically this is a way to check to see if there's kind of systematic deviation from what the model's predicting. The model predicts that at least, for sure we're going to find some alphas that are significantly different from 0 by fluke. Or if I look at 3,000 securities, just by fluke, there's going to be some that are positive, significant, or negative significant. But when we start grouping into portfolios, we're going to decrease the chance of some of those flukes occurring. And a lot of the tests just did this simple test of looking at the alpha. Okay. And this is just a definition of the alpha. So we could do the alpha plus the beta is the actual performance. Because remember, the epsilon equals 0 by construction on average. And the expected performance we already detailed was this part. So the alpha is just what you get over and above what's expected. We already said this, so I'm just saying it again. And I'm saying it again in the context of the way people often talk about alpha is in terms of a risk-adjusted performance. So it adjusts for the beta risk, and it tells us something about performance. Then there's time series tests of CAPM. There's a link here to some tests that I did on international data, which you could explore. There's a number of assumptions going on that I wanted to detail for you because I don't want you to go and think that this is the end-all of asset pricing, this simple model. And there's a number of things that could go wrong. And a number of these things are resolved in the second-year investment course and the international asset pricing course that I teach. We already mentioned that the beta might not be the same through time. The firm changes through time. So the beta could shift. So if you use the overall average beta for a long period of time, and it turns out that the firm is kind of shifted into a more risky set of assets, is that going to cause you to accept projects that you should have rejected or reject projects you should have accepted? Consensus? So let me say it again, that we're using a very long-term beta estimate. But it turns out over the last 5 years or 10 years, the firm has kind of shifted into riskier assets, which means that it could have sold some of its traditional business and started investing in biotech or something like that. Now, using this overall regression over the last 50 years, you get a beta and expected return. And now you're looking to evaluate some projects with that expected return. Like discount rate. Exactly. Okay, so the discount rate should be higher because we're more risky now. That's what really counts. But we're using this discount rate is pretty low because of the history. So you have to be real careful about how the beta changes through time. Okay. The alpha could also change through time. So it might be, and remember this is kind of like an average. So if we look at the definition of the alpha, the actual performance over some period of time and the expected performance over some period of time. Well, it could be that the performance in the first 10-year period was terrible, and the performance in the next 10-year period is great. And then you look at the alpha, it says 0. Like, that's a little misleading perhaps, because this might be the type of firm you're interested in. One that's done poorly in the past and is doing very well now. So just to look at the overall average alpha could be misleading. The error variance may not be constant through time. It's known as heteroscedasticity. That could affect our key statistic on the alpha and the beta. Do you do this in statistics, heteroscedasticity? Yeah. So remember, and hopefully you remember this from stat, that heteroscedasticity does not affect the beta or the alpha. It only affects the t statistic. Similarly, there could be autocorrelation, and I assume you did that also. And also remember that autocorrelation is not going to affect the beta, it's not going to affect the alpha, but it will affect the significance of the alpha and the beta. Number 5, it might be the returns are non-linearly related to market returns. So the beta is a linear regression, where you regress the return on the asset on the market return. It might be that this is not a linear relation. It might be that things like skewness and skewness would come into a model like that by regressing the return on the asset on the market return and square of the market return. And then we get a skewness beta, a second beta which represents skewness. That's a possibility. That's only one example of a nonlinearity too. There can be errors in measuring the market portfolio, so the benchmark you're using may not be appropriate. It's unlikely the risk-free rate is going to be measured incorrectly. I think that's pretty easy to measure. There may be other sources of risk. So far, we've only looked at one source of risk, and that's kind of the benchmark return. There could be other things that have betas that are important. So you can calculate a beta with respect to the oil price change, a beta with respect to the inflation rate in the economy, a beta with respect to interest rates. So suppose I did that. Let's just do the interest rate example. Suppose I regress the returns on the asset on the change in the interest rate. What does the beta represent? Yes.
That if your beta of like was 1, that if interest rates went up, so did the stock in the same proportion.
Yeah, so the beta represents the sensitivity, or let's call it the interest rate beta, represents the sensitivity of the stock return to a move in the interest rate. Right. Suppose we, say it again?
Like a modified duration.
Absolutely. So people talk about the duration of a stock. This is how they do it. So they regress the stock return on the change in interest rate, and the beta is kind of like a modified duration of the stock. Now, if you did that regression for a bond return, the bond return on the change in the interest rate, what do you get? It's a modified duration, or something real close to it. So it's just another piece of risk. So we focused on kind of like a single beta representation with a market benchmark, but it's easy to create more than one benchmark. Interest rate is a prime candidate as a second source of risk. World CAPM, there's an issue of like what benchmark you used. If you use the benchmark within the US or a world benchmark. This is mainly stuff that's discussed in the second year courses. So you should be aware there's a number of things going on in the background that need to be fleshed out in an elective course. Okay? Surely in 6 weeks we We can only talk about some of the stuff. Okay. Cross-sectional test of the CAPM. So this is the second set of tests. And what this is basically to look at the scatter graph. All this is the scatter graph we've already seen. The scatter of returns on the assets versus the beta. And if you put a line through that scatter, it's called a cross-sectional regression. You're looking at one particular point in time across many different portfolios. Okay, and those gammas are just coefficients in that cross-sectional regression. So basically, this is the result of what was done by Black, Jensen, and Scholes. Black and Scholes did a lot of stuff. This is 1972. They're doing this. They're testing. They did the first ever test of the capital asset pricing model. Those guys. And basically, the regression they did was they collected betas on a number of portfolios and then looked at the regression of the average returns on the beta, the average excess returns on the betas, and got these coefficients. The t-statistic was very high, and the coefficient on the beta is positive. Is that good news or bad news for the model? It's good news, right? Because the higher beta means higher expected excess return. What about the t-statistic of 6.53 on the intercept? Is that good news or bad news? That's bad news, because this should be 0. This is not a large number, 0.0036. Nevertheless, it should be 0. So they found some evidence in favor of the model, but it wasn't perfect evidence. That they found that this intercept should be 0, but it wasn't 0 in what they estimated. Nevertheless, it was useful to, basically their test caused a lot of people to start using the capital asset pricing model. Section 8 is supplementary. It's kind of a preview of what we do in the investment course. And Section 9 is supplementary. And Section 10 simply talks about multi-risk formulations and leads you to some references. I guess mainly references that are detailed in the secondary course, but those links are available. Okay? Let's talk about performance evaluation. So this is a handout that's at the back of the class. This is very much linked to what we just did. Because we're going to be using the same tools to talk about performance evaluation. Actually, we've already talked about performance evaluation, right, in terms of that economic value added stuff. So we already have a performance evaluation measure, the alpha. That's mainly what I'm going to talk about. But before we do that, I think it's important that you have some introduction to this idea of what efficient capital markets actually mean. And there's a lot of confusion over this term. And the guy that coined the term was Fama. He's a professor at the University of Chicago and also my dissertation chair. And there's a lot of people that really misunderstand this concept, and I don't want you people to misunderstand it. So the usual misunderstanding is, well, oh, you're a graduate of Chicago. That means that you must believe markets are efficient. And I don't believe markets are efficient. People would say that, or your education from Chicago is trivial because you believe markets are efficient. So that is basically revealing that the person making this statement doesn't really understand the basics of physics. And given that I'm one of these Chicago people, I think that's incumbent upon me to make sure that you understand to some extent what this idea of efficiency is. The first thing is that efficiency is a concept that's a relative concept. It has to do with the speed to which information is taken by the market and translated into kind of a price move. Good news comes along, and how long does it take for the asset price to adjust to that good news? Okay, so it's the speed of adjustment, and it's also the correct interpretation of the information. It might be information that appears to be good news, and the market doesn't move. Is that evidence of inefficiency? Not necessarily, because the market's correctly interpreted that news as, well, it just only appears like good news. There's something else underlying it that perhaps is bad news, and it levels out. So you don't want a situation where news comes to the market, stock price shoots up, and then later people reassess, and then the price comes down. That's called overshooting, and that's inefficiency. And the other extreme is the news comes out, and then the market slowly adjusts to the news, and the stock price slowly adjusts to where it should be. That's also inefficiency. So in an efficient market, news comes out immediately, the price jumps to where it should be. Now, it's a very, in a way, kind of like an abstract concept, because that just never happens. So therefore, the markets are inefficient. Okay? So by the absolute definition of efficiency, everything's inefficient. And everybody from Chicago would agree with that. So the key is, how efficient are the markets? So what is the degree of efficiency? Or the degree of inefficiency, if you want to phrase it like that. And it just has to do with how fast the asset prices move in the information. There's a question. Yeah.
When IBM announced layoffs, their stock price dropped. What was that? That was just a reaction was the day after.
Yeah, it's just reaction to news. Another example is when IBM put their bid for Lotus. What happened to the stock price? The stock price of IBM. It dropped. And how much did it drop? Actually, did the calculations. This wasn't the Wall Street Journal. But you take the market value of Lotus, right, and then you look at the bid price that was announced. Okay, you take the difference. And the difference, I forget what the difference was, like 1.5 billion. It was almost exactly what IBM stock dropped. So it was like the market was almost immediately like taking that difference and discounting the price. So I thought the market was very efficient in terms of that particular acquisition. So this is the key thing here is the question of how efficient is the market. And it's very difficult to measure, but my intuition says that the U.S. stock market is among the most efficient markets in the world. And that I can tell you with great confidence that the U.S. market is more efficient than, let's say, the market in Thailand. Okay? And it simply means that I believe that information is faster to be impounded in the prices in the U.S. than in Thailand. And then I can also say that Thailand is far more efficient than the market in Zimbabwe. It's very slow to adjust in Zimbabwe. It's a very, very small market in terms of the number of stocks that are traded. So I can make relative statements like that, but what underlies this is this real problem, and that is how do I measure efficiency? Like I can make general statements based upon my intuition, my experience with these markets, but how do you actually measure efficiency? And in a way, what you need is hear a statement like the following, that, oh, this stock is trading for $40. It's really undervalued. And it's undervalued because the market's inefficient. That the market isn't correctly impounding me information about this stock, and the price really, should be higher. So let's think about a way to test for efficiency. Well, an obvious test would be to kind of look at these deviations from the true price, right? Here's a security is trading for 40 that should be trading for higher. Now, the problem is, how do we get the true price? If somebody says that something's undervalued, the first question I got for them is, what model are you using to get the true price? Like, how do you know the true price? Like, tell me what you're using. And it turns out it's real hard to specify a model like that. And in a way, what we have done is looked at a model that delivers a so-called true price. So the capital asset pricing model is an example of a model that delivers an expected rate of return. So we could go and look at the expected rate of return given the risk and historically evaluate how close that expected rate of return is to the historical rate of return. And if there's systematic deviations where security delivers more than what was expected according to the risk, and this keeps on happening amongst other securities, so it's not just a fluke of one stock, then can we say that the market's inefficient? Okay, so I've got this model of the true price, the capital asset pricing model. It tells me this is the rate of return that's expected given the risk. It's where the price should be. And I look at the actual price. Do this comparison amongst many different securities. And I find that there's almost always these deviations, fundamental deviations from what the model is telling me. Does that mean the market's inefficient?
Your model would be wrong.
Model. So it's incredibly difficult to make a statement that the market's inefficient, because that statement is based upon some assumption of what the model is that's determining the true prices. So if I find that the stock prices on the NYSE don't adhere to what's predicted by the capital asset pricing model, I guess I could make the statement that the market's inefficient, but probably more likely we have to say it's inconclusive because the model could be wrong. And I listed those 7 different things that could go wrong with the model. So this is a problem. It's not a problem that's just a finance problem. It's a problem in many different sciences of a joint hypothesis, testing 2 things at really the same time. Trying to test whether the market's efficient, but in order to make that test, you really got to test also of your asset pricing model. So it's hard to reject the null hypothesis that the market's efficient when you've also got this other hypothesis in the background that could really mess it up. Okay? So it's extremely difficult to make definitive statements on efficiency unless it's a pure arbitrage situation. If it's a put-call parity violation, and those violations just keep on happening, that's evidence of inefficiency. Those prices of the calls and puts are not being set properly. It turns out it's real hard to find those. For equities, we don't have put-call parity. All we have is some idea of what the stock price should be according to some model. So it's extremely difficult to make a statement about market efficiency. Yes?
Then why, if it's the big investors who make the market and affect stock price, why when Goldman Sachs says they're changing a recommendation on a stock from hold to buy or hold to sell, why is there such a pack mentality and the stock moves the way it does? If they all understand that these models are inefficient.
The models are only approximations.
Yeah, so
right?
why do people
So you're saying, well, why would people?
Believe Goldman Sachs or Bear Stearns or Alex Brown or whomever when they.
Well, because
when
they got people there that are respected people that invest all their time following, a particular firm or whatever. They've got great information. They've got great ability to synthesize that information. And me, I don't have time. I've got my teaching to do, my research to do, my administrative responsibilities, whatever. I don't have time to track this. And if I'm on the inside list for Goldman Sachs, that's going to impact the way I think. So I don't have a problem with that. It moves the market. Now, if it's just a so-called pure herd mentality, those words are words that kind of smack of irrationality, right? Like animal-style behavior, I guess, herd mentality. That could be a problem. Do I believe that exists? Yes, to some degree. Do I believe it's systematic? Maybe not. Because if it's systematic, then you should be able to make some profit on the other side. So again, it comes back to this thing, do I believe the market's efficient? No. Hopefully nobody here does. It's impossible. It's not just impossible because of the joint hypothesis problem. It's just impossible that everything adjusts perfectly to the information. People don't all agree upon how that information affects the asset prices. People have different views of the world. That's going to cause the market not to adjust instantly to the true price, whatever the true price is. So, to argue whether the market's efficient or inefficient, I don't think is that fruitful. The best thing that you can do is to realize that you're probably smarter than the average investor, and you should be able to make more than the average investor. That's basically what I do in my second year course. So here's some tools that the average investor doesn't have a hope of ever implementing or understanding. And we can synthesize an incredibly complex set of information with these tools and get a prediction as to what we should do. And if we implement that, we're going to do far better than the market. Does that mean the market's inefficient? No. It just means that we're smart. And on average, the degree of smartness in the market is less than us. If there's no disagreement in the market, this is kind of interesting. Some people write papers on this in economic theory. If there's no disagreement in the market, there's no trading. Nobody will trade. Why would people trade? I guess there could be some liquidity reason for trading. But basically no trading, there's no disagreement. There's always disagreement. And we just want to make sure that we're right more often than wrong. Okay, well let's continue this discussion after a 10-minute break. Three common sort of versions of market efficiency that you should be familiar with, mainly because people talk about them rather than they're really critical to you understanding finance. One is called the weak form efficiency, and that simply says that it doesn't make sense that you can make a lot of profit by looking at historical price information. So yesterday's stock return, you shouldn't be able to use that to make huge profits in predicting today's return. And the idea here, the intuition here, is that that information is incredibly cheap. It's like the cost of a Wall Street Journal. So given that cost, it doesn't make sense that you can make a huge trading profit based upon yesterday's price move. So that's kind of called weak form efficiency. And people look at like autocorrelations to stock returns for that. And if you look at autocorrelations to stock returns on a daily basis, they're basically zero. The semi-strong form says that no investor can earn abnormal returns from trading rules based upon any publicly available information. And these include annual reports and whatever might be written in the Wall Street Journal. Again, that's very cheap information. And that's true that herd on the street can move the stock price, but the question is, can you get in before it moves? Right? So it's published, and then the price could go higher or lower. So it's not. So people get confused by that and say, well, yeah, herd on the street really moved the stock price for this stock. Therefore, we reject the semi-strong form of conditions. Well, it doesn't make any sense because as an investor, I read the Wall Street Journal before the market opens. But by the time I'm able to get into the stock, in the position, it's already adjusted. So it's unlikely you're going to make abnormal returns by strategy of investing based upon Wall Street Journal recommendations. Or Goldman Sachs recommendations. That also, this information is known in advance of publication too. So some people perhaps profited in advance. The very strong form of efficiency says that no investor can earn abnormal returns using any information. So that includes inside information. And I said here that almost nobody believes that markets are strongly efficient. So, like, I believe that if you've got insider information, that you're going to make some money in the short term. Yes.
What do you consider abnormal returns when you look at mutual funds that outperform the market for a given amount of time? Is that because they take on more risk, or is that they're just doing better?
Well, we'll look at some data on mutual funds. It's true that there's a few that have done better than the market over the very long term. But abnormal, I mean, we want to adjust for the risk. Because anytime it says abnormal, it means kind of the alpha. And you want to look at the alpha over a long period of time. So it's possible that they're consistently doing better than the market, that it's likely that their beta is greater than 1. Okay? And in this case, it's kind of a looser definition of abnormal. You don't really need any model to know that if you've got illegal inside information, that you can turn that into some sort of profit. Like most everybody agrees. So inside information is generally profitable. Okay? I'm not saying you should trade on inside information because the long run cost, you can just look at the short term profit. You've got to do the net present value calculation. I know it sounds kind of trivial, but you have to assign some probabilities of caught and implications. And for me, it's pretty costly to spend time in jail or whatever, lose my job and stuff. So probably not a good idea. And I detail some of these tests, looking at autocorrelations and like that. This is just a regression of IBM on the lagged IBM return. Can you see this? It's okay with the slide on? No? Yes.
Yes.
And you're just kind of checking to see whether this coefficient here, which is a regression coefficient, this is sometimes called the autocorrelation coefficient, whether this is significantly different from 0. And it is, and I actually did some estimation. And these are the t-statistics right here for the autocorrelation. And in the 5-year period, nothing is greater than 1. In the overall period, the t-statistic is slightly more than 2. Again, it's the quirk of using very, very long horizon of data. It does not read that meaningful. Mutual fund performance. So you should mutual fund is kind of like a common vehicle for investment. I've got to admit that I'm invested in some mutual funds, mainly because I'm forced to, because of the pension plan at Duke University. That's really my only investment in mutual funds is what I'm forced to invest in. Whoops. Actually, I think that it's a great opportunity for students of finance to go to work for a mutual fund. There's just so much you can add. It's just remarkable. We'll look at the performance of mutual funds, and you can judge for yourself what you think is happening. You hear about the stars, right? Like what's the Fidelity Magellan or something like that? Great performance. But it's like one of 4,000 funds, right? And just, I think I said this in some other lecture, but if you know just like the most rudimentary thing about statistics, know that there's got to be distribution of returns, irrespective of any skill. And there's going to be some that are on the tails. And I'm not saying Fidelity Magellan is just a pure fluke, but you have to be thinking about that. And I think it's fair not to just look at that one, but to look at the whole distribution. And that's kind of what we're going to look at. So open the Wall Street Journal, and you can see all of these mutual funds. And this is a graph of style. Let me just get rid of it. This is some style categories. So aggressive growth, growth income, income growth, balanced, and income. So these are different styles. It means that these funds invest in these categories. Aggressive growth, I guess you can almost immediately guess, is the riskiest. And I actually graphed some betas of these aggressive growth funds. And you can see the range of betas is the highest. And income is the lowest risk in this category with the lowest betas. So there's style categories that are correlated with beta risk. Okay, so if you invest in aggressive growth, you're investing usually in high beta.
Is the crossbar the mean of the beta?
Within the category. The next is volatility in investment style. And again, you see a relation actually between the volatility and the style. So it's a weaker relation than the beta, but it's definitely there. So again, if you buy if you buy the aggressive growth mutual fund, then that's got more volatility than, let's say, an income-based mutual fund. Okay.
Aggressive growth also is lower than some growth.
The aggressive growth, the mean volatility is higher than growth. But there are some growth funds that have actually higher volatility than the higher aggressive growth ones. This is just a sample of some. It's not every single mutual fund, so it's not that comprehensive. This is average excess returns and investment style. And you can see that there's a relation between the average returns and the style also. And this is really telling us that there's a relation between the average returns and the risk. Right? Because the style categories are correlated with the risk, the beta risk. So the higher the risk, the higher the average excess returns. This is in excess of what the treasury zone. So in a way, this kind of confirms our intuition that risk is rewarded, and that you expect higher performance from growth than aggressive growth. And now I talk about some performance measures. The Jensen measure. The Jensen index is the alpha, simply the alpha. So Jensen, in his thesis in 1968, all he did was to run a regression of the mutual fund return, excess return, on the market return, and calculate the alpha. It seems like a pretty easy exercise, but back in the mid-60s, it was like a hard exercise to do, where you couldn't press a button on the computer and the So what he did, and it was kind of the first study, he basically published this paper, a nice paper, and just graphed the alphas of the funds that he looked at. And the graph doesn't show up, unfortunately. But you've got the graph there. And that's the graph from Jensen. And I've got another graph I'll show you. Yes.
I'm sure this is a really basic question. I'm confused about it. I don't understand what the purpose is of that alpha equation, because if we were ever told to solve alpha, you have alpha in there already. So, like, I don't understand. Is it just the wording saying it's actual performance minus expected performance, and you're not supposed to go into the details of all that stuff? So that's like me saying, well, 5 equals 5 plus 0. You know, it's like on both sides.
Yeah, no, well, you know, I guess you're right. You know, like, you tell me the actual performance of the mutual fund is 20%. You tell me the expected performance given the beta is 15. Then the alpha is 5. Very simple. I guess the trick is, how do you get the expected performance? And And the way that people do that is to run the regression of the actual returns over, let's say, a number of years on minus the T-bill on the excess returns on the market, and you get an alpha and a beta. So
you don't use this then to solve for alpha, you're using it to solve for your expected performance, right? Isn't that what
yeah,
you're saying?
yeah.
Okay.
If you have like any two, you've got the third piece.
Okay.
And we almost always have the actual performance, and then we just have to take a look at the expected and what's left over, the alpha. Okay, so the Jensen diagram, which didn't show up, I've updated this with a paper with Robbie Bonsall. And these are the alphas for 74 mutual funds that have survived from 1968 to 1993. There's only 74 funds in the whole database that have been in existence from 68 to 93. There's like thousands of mutual funds. So we picked the survivors. Okay, so our sample is biased, really badly biased. There's a lot of firms in 1968 that dropped out, a lot of firms that come in and drop. Right? We've got the ones that were able to survive for a very, very long time. 74, that's all of them. And then what we did is we graphed their alphas and noticed that, and look at the blue bars, which is the CAPM alpha. The R-star alpha is something special to our paper. It's another benchmark.
What are the units of the axis, alpha and?
Yeah, this is just the, it's, I think this is supposed to be like 0.5 and 0.10 rep. So this is the, I'm sorry, this is the frequency distribution of the alphas. Okay, so this is 5 of them, 10 of them, and I've labeled the numbers up here. So we've got 26 alphas that go between negative 1.5 and 0. Okay? And we've got 14 mutual funds with alphas between negative 3 and negative 1.5. So this is just a histogram. But the key thing to notice is that this distribution of alphas for these funds that are survived for so long is not impressive. Okay, that most of the alphas, almost all of the alphas are below 1.5. Okay, so if I draw this line here and look across, most of them are there's more negatives than positives. And given your prior that you've got these survivors, it really is not that impressive. These are the T statistics. And again, look at the T ratio for the CAPM. It's in the green. And remember, we're looking for a T statistic of 2 or greater. Okay? A 2 means that your alpha is significantly greater than 0. Okay? A negative 2 means you're significantly poor in terms of performance. And actually, I didn't do the histogram with the break of 2, but we can see that of the 70, how many, 76? 73? 74, okay. Of the 74, there's only 9. So 7 plus 2. There's only 9 that have a T ratio greater than 1.5. So most of them don't have performance over and above what's expected given the risk. And actually, notice that there's 9 down here that have significantly negative performance in terms of the alpha. The other interesting thing is that our benchmark, which we call R star, which is an alternative benchmark, they even do worse. There's only 2 of them that do better than the benchmark according to our measure.
Which ones are those?
It's a footnote in the paper. This didn't go. Now I want to talk about market timing. And we already talked about this briefly. The idea of market timing is that you invest in high beta stocks when the market's going to go up, and low beta stocks when the market's going to go down. Okay. So this is an example, this scatter graph is an example of a superior market timer. And so notice that as the market's going up, which is along here, the excess returns are going up on the mutual fund. So this person's switching into high beta stocks as the market's going up. And this person's also switching into low beta stocks when the market's going down. Okay. And it turns out if you run a regression line through this, that you're going to get the alpha, which is highlighted here, to be positive. Okay, so it kind of confirms that the alpha is indicating superior performance. And also I drew this green curve, which is kind of a nonlinear fit for this data. It emphasizes what's happening to the data. Remember, when we put a regression line through the data, what's the slope of the regression line? The beta. So notice that the beta, not the Sharpe ratio. The Sharpe ratio is the expected excess return divided by the volatility. Okay. And this is just the slope of this is the beta. Notice that the slope is getting steeper as we go to higher returns, which means the beta of the portfolio is higher. So the linear regression is the red, and it just says the alpha is positive. And the problem with this, this alpha measure is highlighted here. What if you've got like a perfect market timer? And this timer, what this timer does is goes into high beta stocks when the market's going up, but then just liquidates or goes into the risk-free when the market's going down. So notice there's no observations over here where the market's going down. So you've got this idea. So as the market is getting less and less impressive in terms of return, you know, we're lowering the beta. And then we're increasing the beta as the market's going up. So you get this kind of nonlinear relation. And the problem is that if we just use the standard market model style regression to do a fit, we get an alpha here of 0. This is a problem with fitting a linear line through something that's nonlinear. And this regression I could have actually showed also with a negative alpha. So if you just looked at the alpha, you might say this market timer who's doing a good job is doing a poor job. Okay, so the warning here is that be careful of nonlinearities that are induced by market timing. That the alpha is not a complete measure of risk-adjusted performance in the presence of market timing. Right. The next performance measure is one that we've already done, the Sharpe measure. Okay. The Sharpe measure is just the expected excess return divided by the standard deviation. It's a measure that's used a lot, even though the risk is certainly not the standard deviation. Okay. So the alpha is the performance minus the expected performance. The expected performance according to the capital asset pricing model or some other model, maybe a multi-beta model. The Sharpe measure is the expected excess return divided by the standard deviation. And we've already talked about the problems with that measure in that it's only good in evaluating mutually exclusive investments. The third measure is the trainer performance measure, and it looks very much like the Sharpe measure, except it's the expected excess return divided by the beta. Okay, and it makes more sense because the beta is the risk, whereas the standard deviation is not the risk. So this tells us the expected excess return per unit of beta. And Trainer is a guy, a very interesting person. He actually sketched out the capital asset pricing model in a note to clients. It's his early manuscript, 1961 or 1962, of the model. And then Sharp, we did not see that manuscript, independently developed the capital asset pricing model. So Traynor actually was often cited along with Sharp and Lintner in developing the capital asset pricing model, but was forgotten when they gave out the Nobel Prize. Actually, he's also interesting in that he had sketched out the Black-Scholes model too. And actually, Black-Scholes cite Traynor. Because Traynor had a lot of coverage for that.
He must be a bitter old man.
Okay, so this is a plot of excess returns versus beta. Notice that I put the security market line on this. The security market line is the expected excess return versus the beta. And these dots are the realized excess returns versus the beta. And basically, the Traynor measure is kind of looking at the slope of a line that goes to one of these points. Okay, so the Traynor measure is the expected excess return divided by the beta. So it's just kind of looking at the slope from this point to any one of these lines. And obviously, a negative Traynor measure is very poor performance. So it's like it's a way to pick off those portfolios above this line. If you're above this line, it means that you're doing better than expected. So that's the third measure. There's also my measure, the Graham-Harvey measure. And there's a hyperlink to the Forbes article called, actually the Forbes article that is called the Graham-Harvey measure. And what it is basically given the volatility of the mutual fund return, what we do is we create a portfolio of S&P 500 futures in money market that exactly matches the volatility of that mutual fund. Okay, pretty simple. So, given the volatility performance, create a portfolio using just leverage, right? Using the formula that I showed you, which exactly match the volatility of the mutual fund return. And then we look at the return of that and compare it to the mutual fund return. Real simple. So we have two portfolios with identical volatility, one mutual fund and one is a combination of money market and futures. And then just look at the returns, the difference in returns. And it's kind of a nice idea, I think, because it's the futures return's passive. It's like you don't need to know anything to do it other than the target volatility. And you can look at, and it's easy to implement, and just look at the return differential. Yes?
Did you do that against a number of mutual funds and find that they were poor performers?
Yes. Actually, in this article, the guy from Forbes did it. And it's, I think, an interesting article. He did stuff that we didn't do. We actually looked at it in the context of investment newsletters making recommendations. So we basically formed a portfolio with their recommendations, right? And then did this S&P futures and money market to match the volatility. And we found that their performance was remarkably bad. It was really bad. Then we kind of said, well, maybe it's bad because they don't have any money on the line. Whereas the mutual fund manager has got potentially billions of dollars and might be a little more careful. One thing to say, this is my recommendation, another thing to actually do it and implement. So we did the investment letters and they turned out quite poorly. And this other guy did some mutual funds. They turned out, not surprisingly, quite poorly too.
So it's basically saying that whatever strategy they're using, whether it's just picking randomly or whatever model they have, is not consistent with the volatility.
What it says is that if you want that level of volatility as an investment, then you might as well just go and lever up or lever down the S&P 500 futures contract. just like you did, some of you did in assignment number 3. That's going to generate a return that's superior to either the fund return or the newsletter recommendation, on average. There's going to be some exceptions. There's going to be some funds that are going to do better. But this is a simple strategy that's easily implemented. You don't need any great knowledge to do this. Pick your level of volatility and you just implement it. So this is this difference between the volatility matched return of the futures and the fund performance is now known as this Graham Harvey measure. So, kind of nice to have a measurement after you waited a long time for that. So people are now thinking of actually reporting this measure. We've got more than one measure you could actually look at in the article. But it's a simple, intuitive way to summarize performance. It's very much related to the Sharpe measure because it uses volatility. And there's also a way to use data in the same sort of measure that we are also exploring. Let's see, conclusions on mutual funds. This is from Jensen. This has to do with the persistence of performance. So suppose last year that the mutual fund had performance that exceeded the benchmark. What is the chance that next year the performance is better than the benchmark? Okay, so given that there were winners last year, going forward one year, what's the probability that they're going to do better than the benchmark? It turns out to be 50%. It's like a coin flip. And if they had 2 consecutive years of better performance, the probability in the third is only 52%. Which again is not significantly different from 50. And 3 and 4, and actually by the time you go 5 consecutive years of beating the benchmark, there's less than half chance that the next year, the 6th year, you're going to beat the benchmark. So basically, this overall, there's very little persistence in performance with one qualification. Yes.
I was just going to, why don't you finish your conclusion, and I was just going to...
well, basically, the conclusion has to do with the people that have looked at this and kind of separated out good performance and bad performance. So if I redo this with bad performance, I get a lot of persistence. So if you're bad for 1 year, then there's a high probability that you're bad the next year. And if you're bad for 2 years in a row, it's even a higher probability that you're bad in the third year. It just keeps on going up. So people talk about persistence of performance, right? And some people actually made the mistake of grouping all of the funds together in one big regression and try to estimate the persistence parameter. They say, oh, it's significant, which means performance persists. Well, a closer examination of the data reveals that positive performance, there's no significant relation. It's a coin flip. So if you did well, then in the future, there's no information in doing well in the past. Okay, so if you look at the performance of the mutual funds and try to design an investment strategy by picking the winners, then it's like a coin flip that your portfolio is going to do better than the benchmark. 50-50. However, if you have a different strategy of looking at the losers, those losers are going to lose again. Okay, so persistence has to do with negative performance. Yes, wish. Well, yeah, it's like basically all of the research, and my research also, that looks at these funds concludes that they, on average, do not, do not even meet the benchmark. So therefore, the implication is short, right, which you really can't do. Short a mutual fund. There's one way that you could potentially do that. And anybody have an idea as to how to do it?
Short all the stocks that the mutual fund holds?
No, because a lot of this is coming from their picking of the stocks, and we don't know exactly what they're doing within like the quarter. And we also, by doing that, also the mutual fund's got fees, like overhead, that's contributing to the bad performance. So that won't necessarily work. What's another way to in a very general sense, short mutual funds.